Hi, everyone. Can you hear me?
I can hear you.
Okay, great. And can you see me?
Well, I can see the presentation, or at least the background.
Okay, I'm trying to put up my video, but it's not cooperating. Let's see if I can get it to work. Seems that it might have to just be a voice session today. Is that okay?
Oh, that's absolutely all right.
Okay. All right, great. Let's see if everyone is here. Right, we've got a few people, so I think we can get started. Great. Thank you all for joining the session today. I'm going to be discussing how to build financial scenarios, or I'll actually be demonstrating how we can build a scenario that can respond to uncontrollable events like the COVID situation. As we know, every business in the last few months has been disrupted by this, has been disrupted and has been forced to get into survival mode. Now, whatever strategic direction that companies thought that they were taking in 2020 are on a completely and radically different path 6 months later. Now, the pandemic has made a complete, you can say it's actually made a complete joke of any projections or forecasts that anyone has attempted to make in their companies. And I just want to quickly introduce myself. My name is Orabetse. I'm the CEO of the Scalable CFO. I'm a chartered accountant by profession, and our mission at the Scalable CFO is to make it possible for startups and SMEs to get top-tier financials advice, to get access to finance leaders who can work with them on a part-time basis. So today, I want to take you through what we typically, or our idea of our scenario planning, as well as some of the best practice approaches to it, and how you can use it as a tool to plan for the future. Now, this is going to be a practical session. I'd like to show you how to actually build a basic scenario model and also work out what the impact would be on the runway, and also how to interpret and present the scenarios. And for that, we'll actually use a matrix or a model that by Sequoia Capital as scenario matrix. Now, any of you familiar with scenario planning or have had to engage in any form of scenario planning in your business? Or if you are working on a company at the moment?
Not really.
No. Okay. All right. And what about just financial planning? Have you been involved in that in the business?
To a very limited extent, I would say.
Okay. All right. All right. So we'll just go through some of the points. I'll try to explain with this unfamiliar terms. I'll try to kind of explain those as we go along. Now, what is scenario planning? So in 1965, Shell actually pioneered the concept of scenario planning. And according to the Corporate Finance Institute, we can loosely define scenario planning as the process of examining and evaluating possible events that could take place in the future by considering various feasible results or outcomes. So in financial modeling, this process is typically used really to estimate changes in the value of a business or to assess the changes in the cash flow. And especially when there are potentially favorable or unfavorable events that could impact the company. Now, many companies in practice have not been using scenario planning, but what we've seen is that in the last few months, especially within our own portfolio of companies, there's been an interest in assessing how resilient the business is under various circumstances or various scenarios. Now, there'll typically be 3 scenarios that need to be assessed, although you can assess more depending on the complexity of the organization. You'd expect to have a base case which describes the expected outcome and is the basis of the management's objectives. And then you have the worst case scenario, which considers what the most severe outcome could be, given the operations. And then you also have a best case scenario, which would be the ideal outcome. Now, to understand the value of scenarios and how they are used, I just want to sort of highlight here that the greatest value really with scenario modeling is that once the financial projections are created for different scenarios, they should really form the basis of your strategic planning. So scenario modeling is not just about plotting scenarios just to see the outcome, but they're actually meant to align with your strategic decisions and strategic direction that you will take under those specific scenarios. So they include differentiated approaches for each of these outcomes. Now, you can anticipate cash needs through scenario planning. You can anticipate inventory needs, or you can even manage expectations with investors as to what to expect with different outcomes. And of late, it's also very much right now, particularly if you're trying to raise capital, it's of interest to investors how your company will look at the circumstances, an indicator that you have considered the different outcomes. Now, the downside of scenario planning is that outcome-based. Other outcomes are based on assumptions and usually on top of historical data, which can make them susceptible to being incorrect. And of course, adjusting if you adjust one driver or individual drivers, it doesn't really allow us to see the full interaction with all variables at times. It has to be done very, very carefully. Right, so how do we build a scenario model? Now, there's some key elements to the building process. The first, you have to identify the key drivers. I'll show you an example how we can do that. The key drivers for growth and even for your costs. And then we need to look at what the uncertainties that actually are. So how do we define the uncertainties based on macro conditions? And these are conditions that are typically out of the control of the company. Then you have to develop a scenario. So what is your base case? What is your worst case? And what is your best case if you will be assessing the best case? And then we need to, what strategies can be, hello?
Sorry, I think for the last 3 to 4 minutes, your audio has been breaking up for most of us.
Exactly.
Oh, okay. For the last 3 to 4 minutes. Okay, so I need to go back a few slides.
Maybe the last couple of slides.
All right, so let's pick it up. Shall we pick it up on what is a scenario plan? Or did you catch that part?
I think the one after that. I think
you can start from here. That should be fine. Thank you.
All right. Okay, great. Thanks for that. Right. So again, what is the value of scenarios and how can they be used? So just to highlight one of the key values of scenario modeling is that once the financial projections are created for the different scenarios, they will form the basis of strategic planning, which will include differentiated approaches for each outcome. So you create multiple scenarios and they just it's just a matter of it's a numbers exercise, but the strategic direction or the strategic response to each of those the specific scenarios or outcomes. Now, we need to also anticipate cash needs, which is very important, and to assess how long your runway will be. We'll be looking at that today as well. You can assess the inventory needs, and you also manage expectations of investors on what to expect with the different outcomes.
Excuse me, I'm sorry for interrupting, but again, the disturbance is back.
Perhaps what is it? Just disconnecting, or what is the issue? Can you hear me now?
The reception seems to be bad. The voice is breaking.
That's okay. Because
If you're you're using a headset or a speaker, maybe that's causing the issue.
Is that better now? Can you hear me now?
Now it's clear.
Maybe what I'll do is, if you just give me a second, I'll just grab a headset. That might actually be clearer. Okay, let's see. Is that any better? Yeah?
We can hear you, or
Okay, is that much better? Is that a bit better?
There's
yes,
still
your voice
there
is
is still some noise in the background which comes and goes, so we hope it doesn't come back.
Okay, all right. Okay, let's hope this works. Sorry about that. Okay,
I'm sorry, it's back.
you would, Sinar.
We can't hear you.
That's very strange. What's causing
Or
this one?
try
Hi.
to find try to find a place where you're close to the router or Wi-Fi
I'm
signal.
actually quite close.
You're close? Okay.
Yeah, let me check again. If I can find this. This is very strange. Still not. Hello?
We can hear you, or
Okay, all right. Let's give it a try, and hopefully this will
sounds better now.
cooperate. Okay, all right, great. Right, so yes, as I said, you can anticipate cash needs and inventory needs, and also you can manage expectations with investors on what to expect with the different outcomes of your business. Now, the downsides are that the outcomes are all based on assumptions, and this is done on top of historical data. So this makes them susceptible to being incorrect. Now, adjusting each driver individually also can lead to, or can also individually doesn't actually allow us to analyze the interaction or the correlation between the variables. So we may need to really be careful in terms of how we adjust the different the drivers. And obviously, on the opposite side, if you actually adjust the drivers all at once, you also don't get to see the individual impact of the drive of the changes. Now, the scenario building process is complex, but it's useful. So I will take you through a step-by-step process of how we can do that. We can do this. The 5 key steps are that we will first identify the key drivers, and this is for revenue growth and also for the cost side. We'll look at what the uncertainties are, or at assessing what uncertainties we are faced with. So defining these uncertainties based on macro conditions. Now, macro conditions are conditions that are out of the control of the company. We'll also develop the scenarios for different cases. So base case, worst case, best case. Now for the example that I will take you through, we're going to just look primarily at the downside. So we'll look at the worst case. And then we'll look at the strategies. So we'll discuss the strategies to respond to these macroeconomic conditions. And finally, we'll look at the impact and analyze what the financial impact on the profitability and the cash would look like. So to give you an idea of what this, at the end of the day, we'll end up with the matrix that shows us what the impact of our strategies that we will undertake under different scenarios, what the impact on our profitability, on our runway, and our cash will be under these various scenarios. Now, as I mentioned earlier, we want to look at the macro scenarios to assess, to actually assess what the uncertainties are. Now, these are the ones that are out of control, for example, the lockdown. So in this case, this is actually a matrix provided by Sequoia Capital, which was to identify or to assess what the impact would be on the business under different assumptions of how long the lockdown would be. So we'll follow a similar approach in the example that we'll do. And then we'll also look at what the impact would be if we applied the strategies mentioned of reducing operating expenses to actually assess what the impact will be on the runway and also on our profit. Now, I'm just going to switch over now to the example. All right. So I've just, I also share this with this template with you, but I've just provided here a very, a tool that we can use to scenario plan. Now, just make this a little bit bigger so you can see. As we mentioned, the step number one is that we need to assess identify the drivers. So you might have built something that looks like this, or you might have a profit and loss statement that already tells you what your expenses. So it tells you what your revenue will be. It tells you what your cost of sales will be, and it tells you what your operating expenses will be. So you might have already done this assessment. Now, what we need to do is think about what are the drivers of each of these elements of the financial statements. Now, just in case you're not familiar with the financial statements, I'll just quickly go through some of the key numbers that we're looking at. Your profit and loss statement, which is sometimes referred to as the income statement, usually has at the top line has your revenue, which is what we see over here. And there could be a breakdown of the different types of revenues that make up that total revenue figure. Then you also have cost of sales. Now, cost of sales can differ depending on the type of company that you have. For a service-based business, for a product-based business, it can be different. So here we have got three types of cost of sales numbers: marketing, product, transaction cost. But again, this can differ. What cost of sales really is any cost that you can directly attribute to your sale. So a good way to, the rule of thumb with this is to ask yourself, would I have incurred that cost if that sale did not happen? And if the answer is no, I wouldn't have incurred that cost, then it's not cost of sales. So that's the second line. Now, when you take the difference between the revenue and the cost of sales, it gives you the gross profit margin, or the gross profit, and which you can work out the gross profit margin. The next section is the operating expenses, which are typically have four key spending buckets. I've just mentioned these in terms of the key buckets, although this is obviously not the technically, it might not align with technical standards, but at least it gives you an idea of the type of expenses. So sales and marketing, technology, you have people expenses and operations. So these are your operating expenses, and then what's not on the profit and loss are other types of expenses, like your capital expenditure, that are not considered to be
they are capital in nature, so they're not considered to be operating expenses. So those would not be mentioned here. And then you also have to consider, you know, what your working capital would look like. Working capital being your who owes you money, who do you owe money, and what is that position? Because that also would be a factor when it comes to thinking about your cash flow. So this is just a basic statement that we would want to see what the impact of our scenarios would be. We want to see them. We want to evaluate it on a similar format. So we'll use the statement as a baseline statement that we will assess. Is that all? Is there any question on that part? Hello?
Okay for me.
Okay, all right, great. Right, so now let's look at what we need to do first, which is identifying the drivers. Now, when you're looking at the drivers and assessing what the macro scenarios need to be, in other words, what are the types of things that can be completely out of the control of a business as far as generating revenue or generating sales is concerned. And you can have certain, depending on the complexity of the business, there could be multiple moving parts to how you generate the revenue. So there's units, there's prices, there's growth rates, there's many drivers or many things that can contribute to that revenue. So you might want to isolate these, as that's one approach that you can take, is to isolate these and ensure that you have a mechanism of adjusting those elements and seeing how that can affect your numbers. So right now in this model, we've actually got a baseline. This is your base level of profit and loss, and you can see here we have a revenue of 1.3. If I were to adjust and say, well, let's say the market demand just completely, if you're in a very sensitive industry and all of a sudden the prices drop, let's say for instance the oil industry, then you would you would adjust, you would put your the impact or the driver, you would adjust your driver, and that should actually adjust your revenues and your sales. Now, as you can see, there's something that's not working. That's okay. So let's just do it in the base case scenario. So that should, if we adjust here, that should be adjusting. But yeah, it's adjusted our margins actually. So we've got, it was 55, now it's 50. It's 57. So we will leave it at 0. That's a more complex option, which I will not explore in detail today. But I just wanted to show you that you have the option of looking at things from what the actual individual, drilling down into the key drivers that affect your business, and then adjusting there to see what that impact will be. Now, what I want to look at now is, let's have a look at it from an event perspective. So looking at it from a holistic rather than drilling down. As we know, with the lockdowns that have happened, there was no time to assess the individuals or the individual drivers. It simply affected sales in some industries completely without actually being able to assess the drivers. So there were some industries where they had to completely had zero revenues during that period. So this model second option is looking at it from that perspective of what would happen if now we were to assess, if we were to completely consider what the or rather consider the months of lockdown as a revenue loss event, right? So now the event itself is the loss in revenue, and then we want to convert that and assess that in terms of percentages of our total sales, so we can get a good understanding of, or we can at least put it in a number that's easy to visualize and to see and to actually put a value. Rather than putting a value, you put a percentage, so it's easier to explain and to say, well, revenue dropped by 22% because as for what was projected for the year because of the lockdown. Now, where the assessment now of the uncertainties comes in is that we don't know how long let's say we go back to March. We didn't really have an idea or a clue of how long this lockdown was going to carry on for. So you want to actually consider scenarios, a number of scenarios of the lockdown, as an example. So in this case, the base case, as I said, we're not assessing the best case scenario here. The starting point is the base case just for the purpose of this exercise. And then we said, okay, let's say the lockdown is for 3 months. What would that mean? And what about when it's 6 months? And what about if the lockdown is 12 months, or our sales are take that long to pick up? In some cases, it could be that it's 3 months, but then because you need a lead time to maybe order in stock or to do marketing, the impact would actually go on for longer than 3 months. So you have to consider how your business functions or how your business operates in order to understand what is the likely impact on your revenues that are completely out of your control. Now, for the assessment of the loss, it's really just a simple exercise of going back to your projections. So as a starting point, you need to have your projections. You need to know what you are planning as a base case. And you simply go and you see within your base case, which periods are you going to actually be potentially losing revenue over? So if you're saying that 6 months from, let's dial back to March. In March, everything there were lockdowns that started happening. So if you want to assess the 3 months of revenue loss, you would just take the sum of March, April, and May. March, April, and May gives you 143, and you simply put that there. That gives you an indicator of what the drop in revenue would be compared to the total revenue for that period under assessment. 6 months, you will do the same thing. So you would actually go and say, okay, we've got we potentially could be losing revenue for these 3 months, for these 6 months. So what would that actually mean given our projections? And in this case, it's 344. And in fact, we could probably adjust this. I think we've got 293 here, but let's assume it's 293, just so we don't actually have to change the figures. It is 293. Okay, so this is the 6 months. March to August is 293. Now, 12 months would be from March all the way through to Feb next year, which is 613. And again, we put that figure here. So now you have a quantifiable amount of the impact on revenue of these lockdowns for your business. Now, going back to the 5 steps, we've looked at the drivers. The second part is that we've looked at just show it to you. So we've looked at the drivers. We've looked at the uncertainties. We've understood what the impact of those scenarios would be in terms of our revenue. Now, the next step is to look at what strategies can we undertake to address those losses, right? Now, this is the second part of this table. Now we want to look at what are the potential things we can do in the business to actually mitigate this loss or to address this loss. In some cases, it's very difficult to actually identify opportunities to reduce our costs. It could be that your operating expenses you're locked in, but again, this is something we still have to assess and know what the impact is there. So you just have to, and obviously considering what your business operations look like, consider where the possibilities are to reduce. So assuming that you've got sales and marketing, technology, people, operations that's completely unrelated to sales. In other words, they will not reduce when sales reduces. they are your overheads. You would need to go in and then work out what can you do as an organization to, or as a team, to try to address that. Now, this is obviously a very simplistic representation of the impact that you can target, but it's a starting point for us to assess what percentage adjustments you need to be making in order to start seeing what that how that can affect your how that can mitigate the loss. So yes, here we've written 15%, but we know that within each of those cost driver or each of those spend buckets, you do have underlying drivers that will impact. So this is we'll not dive into the details of that, but again, you would need to know, for example, sales and marketing, there could be a component that is where there's efficiency, or it's dependent on the number of sales staff that you have, or it could be you could have your office space is dependent on the number of or the size of your team, and you might be able to, in order to reduce the operating expenses, you need to look at headcount, or potentially reduce the working hours, or as whatever is available, opportunities are available to you within your organization. So this is just a high level assessment, but from a management perspective, you want to look at it from a high level, and as well as obviously look at it bottom up to try to assess what the possibilities are there. So now we've defined the strategies, and that, okay, if the potential things that can happen is that you could potentially reduce your operating expenses by 15%. You could potentially reduce your operating expenses by 25% as a plan C. Those are the possibilities available to you. Keeping in mind that these are independent of the scenarios. It's just what are the possibilities what are the measures that you can take, and you can think of them as trigger points. So say you get to you realize that 6 months lockdown actually has a very adverse impact on your profits and your cash. Then you say, well, actually, maybe we need to switch to plan C now, because plan B is not going to be sufficient for us. So it's really meant to be more of a strategic approach to what actions you will take when you are seeing that there's not going to be or the impact is going to be quite devastating. So let's assess the impact, right? That's the last point now, is to see now that you've got your scenarios mapped out, you've got your potential strategies identified. How does that actually work in terms of numbers? Keeping in mind, you can always come back and adjust these until you get to the right mix of scenario versus plan. Is that all clear? Okay, I take it that means no question.
Excuse me, just
Yes.
a quick question.
Yeah.
Now,
Yes.
these scenarios are based on assumption. How we as an organization can monitor these assumptions?
Okay, so when you are preparing your financial plan as an organization, you really want to make sure that your plan, the basis of calculating, for example, revenue, right? So you know that revenue in the simplest form is units and prices. So you within the organization need to be able to assess, to measure the units, and you have to have a mechanism of getting real-time data on that. Now, in terms of the loss event is something very, it's a macro event. So it's not something that is fully within the control of your business. But with the loss event, how you can measure that outcome is that, again, you need to make sure that, because this is actually looking at revenue as a whole, meaning whatever you're reporting on revenue, your revenue is your KPI that you need to monitor. So that's how you would need to continuously have a very clear visibility on what the impact is on your key performance indicator, which in this case is revenue. Does that answer your question?
Okay, thank you very much.
Okay, great. Now, right, so now we've mapped this out. let's have a look at how that impacts your profitability and your cash. Now, I want to just take a moment to just explain here the difference, because your profit and loss statement is not it's not reflective of your cash position. And as you know, with these, when it comes to really assessing, the sensitivity and the risk exposure, cash is one of the greatest indicators, and you need to really consider that. We've seen a few times, or many times, companies sort of focusing on wanting to show, looking at the P&L and being very concerned about the P&L, whereas actually the bigger issue is on the cash side. So it's good to keep both, to assess both, but to always, when you're talking about the impact on your runway, you want to make sure that you convert your profits to cash. So the profit and loss, as we discussed earlier, has the key numbers there are your revenue, your cost of sales, which gives you your gross profit, your operating expenses, and finally your earnings or your net profit. So we call it here EBITDA is earnings before interest, tax, depreciation, and amortization. But for the purpose of this exercise, you can consider this to be the net profit, as we did not factor in depreciation. Now, this is an indicator of, within a certain period, how the income, so that the billing, so all the invoices that you've issued, how they compare with any costs that are associated to the same period that those invoices were issued. So so if we're looking at 12 months, we need to make sure that we consider what are all the invoices issued in the 12 months, and then what are all the expenses that are incurred that relate to those invoices within the 12 months. Now, here we can actually, let's take it down to 12 months. So if we go to, I've actually included a flexibility to look at to extend the period. The reason why you might want to extend your period of assessment is that your when it comes to these uncertainties, like the lockdown, you don't actually have, you might want to consider what the impact is beyond the year. So if we're saying 12 months, we're starting in March, 12 months from March goes into 2021. So you want to kind of understand what the cash outflow and the impact would be for that entire period. Hence, we have the flexibility. But for purposes of reporting a financial statement, you always do it on an annual basis or on a 12-month basis. But this is just an exercise, a tool to assess the runway. So we will consider this as 2 years, because we have a scenario here that goes beyond 12 months, as we had started our lockdown in March. So let's keep that as 2 years, so we can cover the full spectrum. So you've got your profit and loss. Now, this profit and loss is the cumulative of the two periods of 2020 and 2021. This would be for 2020 only, but let's stick to both. Now, what do we do now to convert that profit to cash? To convert to cash, you need to remember that even though you have invoiced your customers during that period, they might not have paid you. Or even if you have received bills from your suppliers during that period, you might not have paid them. So we need to factor in that working capital, those changes in our working capital, and make sure that that is captured, and that we understand how that affects how that changes our profit to cash. So in this case, working capital is 22,000. I will not get into the details of how to calculate it, but I will share this sheet with you. You can actually see where this number comes from, and it actually is a combination of your changes in your accounts receivable, your changes in your liabilities, and also if you have inventory changes in your inventory. So that tells us that with all of this money that's tied up in receivables and in assets, less the money that we owe to others, we have a reduction of our profit of 22,000 from our profits. So we have to adjust for that because now that it gives us a better reflection of the cash flow. Next, we want to also look at what are your capital expenditures. These are costs that would not be sitting on your profit and loss. They would not be sitting in the P&L. These will be expenses that are sitting, that will go straight to your balance sheet and be capitalized. So these, we have to also adjust for those. If you plan to invest in fixed assets, you plan to invest in IT equipment, or even if you plan to capitalize some software development costs within your organization, you need to factor those in because they either the changes in those balances are not actual, they're not actual profits, or they're not actual cash movements. So we have to adjust for those movements. So that's this adjustment over here. By taking these capital adjustments out, we get to our actual operating cash flow. So you can already see how it's been affected quite a bit. So we thought we had 144. In actual fact, we've generated 97,000 in cash flow. Now the next step is to think about how do we now take this. Now we know how much cash we've generated in 2 years. We will generate cash of 97,000, assuming that we receive if we build this amount, assuming that we've had these capital expenses, then we would generate 97,000. Now, when it comes to assessing your runway, we want to understand what is the burn rate of your business. So the burn rate is how much are you actually spending without considering your income. So let's say let's say today you've got a bank balance of 100,000. How long will that last you to actually, without, in the worst case scenario? So that in that case, we want to work backwards and see what is our actual cash outflow. So to do that, we just remove the margins. So by taking off the margins, we get from my cash, so we generated 97,000. Our margins were 719, meaning that our actual operating expenses is 621. So we want to, we need to actually pay at a minimum 621,000 over the 2 years. Now, what is our average monthly burn rate? We divide by the number of months during that period, and it gives us 25,000 as the burn rate. Now, our starting cash, let's assume our starting cash balance at the end of March is 250,000. Then if an investor asks you, how much is your runway? You can tell them, well, actually, given that we have this much cash balance of $250,000 and a burn rate of $25,000, we expect our cash to last us 10 months. So our runway is 10 months. Does that make sense? Okay. I take it there's no questions there. So I'm gonna move on from that point. Right. So now the next part is to then put it all together. We want to see what each of these scenarios will give us as an outcome, right? So let's just make sure we can see everything there. Let me know if you have any issues seeing. So let's assess what happens in the scenario A. Scenario A, we said, is a 3-month lockdown. So now you can see that immediately from the base case of 1.3, we now have 1.1 in revenue. We've actually lost some revenue. Now, with that, and with the base case scenario, your earnings have reduced, and they're now 6%. Your cash outflow remains the same, actually, because your margins, you've just simply taken off your margins, and everything, your burn rate remains the same because nothing has changed in terms of what your outflow will be in terms of operating expenses. So your fixed expenses remain the same. You've just reduced your revenue. So now you know, okay, this has been the impact. It's gone down to 6%, whereas before it was 11%. Now we say, okay, fine. Let's assess scenario C, which is quite extreme. Scenario C has a very adverse impact. You've now got minus 28% in profits. If your profits are minus 28%, it means that you are making quite, you're already quite in a very adverse or in a devastating situation, really. It means that you cannot cover your operating expenses. So you need to actually see what scenario can kick in at this point, right? So let's say, okay, fine. So we realized that we've got 28 impact of this lockdown is that we would be at 28%. Your operating cash would be negative 239. So you'd be in a negative cash position. So you're actually going to run out of money. So what can we do in terms of our strategies? Let's kick into the most extreme strategy, which is Plan C, and let's see what happens there. So Plan C, you see, Plan C improves the situation. It doesn't quite take you to profit or doesn't quite take you to profitability, but it does reduce. So in this case, you might want to play a little bit with, actually see where else you could potentially adjust. So let's say we adjust our sales and marketing. If we adjust sales and marketing to 50%, what we see is that now we break even. We just about cover our expenses from a profitability perspective. And from a cash perspective, we are actually still in a negative operating cash position. So again, you might have to take some more drastic measures, which then improves your profitability. You're still in a negative operating cash position. So you want to see what else you can do. Now, after adjusting sales and marketing, technology, and people, now you're in a positive position in terms of your profitability, and you're in a positive operating cash position. So by playing around with these, you can get a sense of what are the high-level strategies you need to take in order to cope under specific uncertainties. So I'll just take that back. So what now you can do is you can assess, for the purpose of of presenting this and actually having a full view of the scenarios, you can actually do a table, or build a table that has all the different outcomes. So you have your plan A with your scenario A with plan A, what would happen? You look at scenario A with plan B and see what does that mean for you? What would happen under that scenario? And then you can have plan A with plan C to see what happens under that scenario. Same thing goes with plan B. You can assess for each scenario what the impact will be on your cash and what the impact will be on your profits. Now, once you've done this assessment and you've mapped it out for different, and you collect all the data or the different outcomes for different scenarios, we can then present it in a matrix format so you can see that impact. So I've already done this in advance, so you can see what that would look like. So in this case, with these numbers and these examples, what we see is that our profit, our base case was a 12% net profit and a 1.3 million revenue. And it gave us 10 months of runway in a worst case scenario. Now, our scenario A, you can see that scenario A is generally quite, you're not in the red under all cases. So scenario A, if you go into plan B or plan C mode, you're relatively in a good position. So your revenue is slightly less, but you're still profitable, and you still have some runway. Now for scenario B, we've got 6 months of lockdown. You are in an adverse or in a devastating position, or not as devastating as scenario C, but you are in a bad position because you are in a negative profitability. If you're in negative profitability, it means you're probably in negative, you're not generating cash flow either. So you want to probably switch to plan B or plan C under scenario B. Scenario C, we assessed this together already, that currently the strategies that we have in place will not actually be helpful, or they will not alleviate the circumstance. And this is where this you know, you're in the red essentially. So we need to see what can we do to address this. Now, in some cases, you get to this point and you realize you can't really find anywhere else to adjust, and you've really squeezed out your OPEX as much as you possibly can. This is when it starts to get, you might need to start looking at your business model and really understand what are, where the opportunities potentially lie as far as tapping into additional revenue, shifting or pivoting the model slightly. You know, we've seen organizations where a good example is a company that we work with where their revenue was based on footfall in within a restaurant or within retail outlets, F&B outlets. So you can imagine during the lockdown, they completely couldn't generate any revenue because it's based on footfall, and therefore they if there's no people coming in, they cannot build. So they had to pivot their business and see what else can they do. So they because they were in the business of capturing data and assessing you know, the I guess the different areas as they started you know, the timings changed and the curfews changed, and that sort of data they were able to capture through their technology, which was installed in the restaurant or in the grocery stores and restaurants and so forth. They were able to work out a way to actually present the data and provide it to the government, who was able to use that and kind of buy the intel or the resources from them. They then also ended up pivoting to online because they were able to adjust their technology to allow the same customers that they had to operate online. So there's, in that case, you know, they were in an extreme situation where there was nothing that they could do to alleviate the operating the pressure on the margins, because there's no revenue and also OPEX, there's no opportunity to reduce that. So they had to kind of resort to much more extreme measures of essentially pivoting their business to actually address that. Are there any questions on this before we go back to the slides? Okay, so now the next thing I want to just show you is what the world's best economists think that the main scenarios are. Now, obviously, this is one of the things that we didn't touch on is how do you actually work out some of these scenarios. We looked at it based on a very a revenue loss, which is very finite and it's based on your own projections. But how do you know how do you assess how long this lockdown will be, or the impact on the economies and therefore potentially trickling down to the impact on the business? So a good place to a good resource is actually the organizations like the IMF. They've actually they have a report that they issue. They've actually called the COVID-19 crisis as the great lockdown, or the worst economic downturn since the Great Depression, and have actually built scenarios based on assessing what the risk will be. Now, obviously, being economists, they've calculated the risks only on the downside, so similar to what we've done, what I've just shown you now with the Sequoia Capital Matrix, and they've done this based on this is based because they wanted to just isolate this based on their estimate that this is where the majority of the risk lies. Now, their baseline scenario assumes that the pandemic will actually fade in the second half of 2020, and that the shutdown measures will actually reflect this. So if we go to, they actually have, I will share the link with you, but they do actually have a table that they've issued that shows the projections for across 2019. The last one that was issued was in June. So that table will show, you know, the world output or the GDP impact, annual percentage change to GDP for different markets. So advanced economies and emerging markets. So again, that could be a good indicator of how you can adjust and build your scenarios. But on a high level, what they've done is that they've taken three possible outlooks. The first one will be that you have a 50% longer recovery. The second one is that there's a second wave outbreak later on. So the way that we had taken the months consecutively to look at the impact of the lockdown, you could actually take the months at different sections of your plan. So look at 3 months in 2020, and then another 3 months according to when they predict the pandemic, the second wave of the outbreak to be, and look at that at those 3 months, and then see how that what that number comes to. Or it could be at a combination of the two above. So there's a couple of possible outlooks that you can look at and get some, I guess you can get some guidance from what they are doing. Now they've also additionally to this, what they've done is all the three scenarios that they've mapped out contain 4 common elements. One is that they look at the direct impact of measures to contain the virus, tightening the financial conditions, and also discretionary policy measures to support incomes and ease of financial conditions, and also any kind of scarring that might result from the economic dislocation and policy measures that were unable to fully offset the conditions. So it is a reliable source, I guess, of a good source to kind of get a sense of what they are looking at and how they are assessing the uncertainties. Now, the do's and the don'ts, just a quick recap on this. So there's a few things that are quite important when you're building scenarios. You need to look at your information, you need to look at the trends, you need to look at historical data, you need to look at the confidence, and then look at views. Now, as far as information is concerned, you want to expand info as much as possible. So, review all the trends that could affect the business and consider the interconnections, and also use only internal information, or don't use only internal information and ignore the macroeconomic. So we really have to look at it from a holistic perspective. Then the trends. So it is important to remember that because we are looking at trends, unlikely events are unlikely for a reason. So we need to be very careful not to look at scenarios that we know for a fact are unlikely. Now, historical data. Now, the past is definitely not a good predictor of the future, as we've seen. So try to reflect scenarios that would or to build scenarios that would reflect the most relevant, uncertain outcomes. And then also definitely do not assume that things will not change. I think another thing that's very important for this when it comes to historical data is that really you want to involve everybody in the company in terms of assessing what how to predict and to model the strategies and also the uncertainties. And then the confidence, we need to really be aware of overconfidence, especially as I mentioned earlier. I think it's very safe to say that this whole the last few months have made a complete mockery of any kind of plans that were done at the beginning of the year. So it really is, it humbles the people who are tasked with financial planning or financial management of their organization, because really, I think anything that people kind of imagine would happen has not happened in the way that it was planned. You know, finally, I think the last point is to just really get as many views, many points of view as possible. So engaging all the stakeholders in the process and making sure that all the strategic responses, everything that could be potentially done, is identified and also is actionable. And finally, let's not create, you know, scenarios that cannot, that are not practical, or even a groupthink where there's sort of a similar point of view, you know, for a certain outcome. Now, that brings me to the end of the session today. I think we have a few minutes, but actually we're out of time actually. So just to conclude, I would say that scenario analysis is really an instrumental tool for management, and I think if more than anything, it really helps companies to navigate complexity and also unexpected situations. At least you have some level of comfort and some level of idea of what the impact would be in the business. I think more importantly, it definitely provides any stakeholders, in particular investors, insights into the outcomes of the actions, so that there is confidence that you know, the company knows what to do and has thought about ways in which to reorganize itself under these conditions. Great, thank you so much for listening. Is there any questions on this before we end off?
Thank you. All good for me. Thank you.
Okay, great. Thank you. It's a pleasure. All right. Thank you so much. I appreciate you all listening in. And if you have any questions, please feel free to get in touch. If you'd like to receive this model, I can also share that with you. I'll share it with the Astrolabs team, and you can try to see if you'd like to use that. If you do use it, please provide some feedback. Always like to get some feedback. Great, thank you so much.